Hello, this is Dale. In this video, I'm going to be discussing, are credit spreads the best way to invest? Again, my name is Dale Brethauer, been a trader for greater than 4 decades, hedge fund manager, and I am the stock options coach at www.optionsinfinity.com. We specialize in credit spreads. And we've been publicly releasing trades for 11 years now. Every year has been a profitable year. We average about 75% winners, and we win more than when we lose. In a recent webinar, I had a mentee ask me the question, Dale, the credit spreads are awesome and we're learning a lot here, but how do they compare versus just buying the stock directly? So I went in and did a study. The first 4 that I did were just random. They were 3-month studies on Target, Danaher, Caterpillar, and Eli Lilly. When I looked at credit spreads versus the stock and straight calls and puts. Then I went in and looked at 3 actual trades. A couple of these were actual losers, and looked at the credit spreads versus the calls and puts and stock for Goldman Sachs, Medtronics, and Caterpillar. The first one we want to take a look at is Target. And the study I did was from December 20th of last year until March 21st of this year. You can see that the price started to go up, kind of went sideways here for a while, dropped, and then ended up for that time period. However, we got in about right here, and this is about where we were at the end of the period, just up a little bit. So what I did is I went in and bought a bull put. I went out to the 14th April, bought a 195, 185 bull put. We want to go out of the money, and I established the sell strike price at about a delta of 0.2. Then I want to go 10 points apart from that to buy an option further out of the money for protection. We got that for $1.90 credit. Now, what I wanted to do is I wanted to make sure I was investing the same amount in options as I were in calls, as I were in straight stock. So I just said, well, let me get 6 contracts. Now, we're 10 points apart, and there's 100 shares per contract. So that's 100 times the 10 points, 1,000 times 6. So I was investing $6,000 in the bull puts. So then I went and bought a call, 14 April call, same time. The 210 call, that was at the money, and that was $19.45. Quite a bit more than buying a bull put. These are both bullish strategies. For these 3 contracts, it came out to be close to the $6,000. So I had 3 contracts of calls, 6 contracts of the bull put. For the stock, it was sitting at 219. I bought 30 shares, and that was about $6,000. So I had about the same investment here as we go down through. So after the first month, you can see that we're about where we were when we started. The bull put had made $180. The call was down $180. Because remember, when you get a straight call, you not only have to be correct on the direction, but time is your enemy. The longer you stay in that option, that premium erodes. And that's actually where we make the money on credit spreads. The stock actually was up just a slight bit here at the end of 1 month. At the end of 2 months, it was down. It was down. The bull put did lose about $1,000. The call lost $4,200 because it's gone in the wrong direction and you're chewing up just about everything you've got in there. The same time this drop is for the stock, you were losing about $690. Okay. Then the price rallied, ended up just slightly higher than it was way back here. Final results were with the bull put, I made $1,000. With the straight call, I lost close to $1,400. And the stock, I made $120. The advantage here most definitely goes to credit spreads. Okay. Okay, the next one we looked at was Danaher. Danaher started out going up. Again, I did a bull put. You can see that the regression line was sloping up, so I figured let's go ahead with a bullish trade, and I got calls. Okay, Danaher went up for the first month, went down for the second month, and stayed about even for the third month. So let's see what happened here. For the bull put, I got a 17 December 292.80, and that was $2.07 premium. And for the call, it was 21.50, quite a bit more. The stock was about $319 at that point, so I bought 20 shares. At the end of this first month period, I was slightly up on the bull put. I was up a little bit more on the call because remember, it went in the direction I'm looking for. And as far as the stock's concerned, it was slightly up. Well, the second month we had a considerable drop there in Danaher. And the second month, we were only down $18 for the bull puts. Remember, on a bull put or any credit spread, you can win whether the price goes in the direction you think, bullish or bearish, or if it goes sideways, or if it goes down slightly. And by slightly, I mean you want to stay above where you've got your credit spread set up. So we're down $18 here. As far as the call, I'm down close to $4,000 because that has eroded everything there. And the stock, I'm down 300. Then it rallied a little bit, so it ended up that the bull put made $700. The call was still down $3,300, and the stock was down 120. Advantage credit spreads. Like I said, not only does it have to go in the direction you're looking for, it can go sideways or slightly against you. Time is on your side, so the longer you're in that trade, the price erodes because of theta decay, and that's your advantage. Whereas in the call, that goes against you. The next one we looked at was Costco. Once again, the regression line was sloping up. Here is the bull put that I set up. This was a 21 January 425, 415 put, $1.50 premium. Once again, the call was quite a bit more expensive, so I got less of those. And I only got 12 shares because it was sitting at $462. Okay. The end of that very strong month, that's where the straight call is really going to make its profit, and a lot that fools a lot of people because they look at that and they say, well, why would I do anything else if I can get all that profit? And what they fail to realize is the risk reward on a straight call or a put is bad, because if it doesn't go straight up, and it goes sideways for a while and then it goes down, you're going to be in a hurting position. And that's exactly what happened here on Costco. So let's look after this first strong month. The bull put is up close to $1,000. Now, the call is up $19,000. That is fantastic. Fantastic. However, this is a lot of anxiety because when's this going to crash? When's this going to go the other direction? With the bull put, I don't have that anxiety. I mean, I don't chart hawk. I don't watch the market all the time. I know if I've executed a good credit spread that I allow it some time to work, and if it goes against me, I just get out. Okay, and I've got rules to do that. I never take it all the way to expiration. Okay, because we did have a big rise in Costco, stock had made about as much as the bull put. There's the big winner there. Then now the second month it kind of went sideways, but it really, it kind of went sideways. So on the straight call you made a little bit. We made a little bit more on the bull put, and the same thing on the stock. And then along comes the third month, and the bottom falls out. The bottom falls out. I made all the credit right here, $900 of this $1.50. Maximum credit would have been 1,500. Once again, I hardly ever take these all the way to expiration. When I've had a good profit, I get out, and I've got rules, exit rules, not only when I take a loss, but exit rules when I have a gain. $900 here on the bull put. We had on the call, it had dropped close to $20,000 back to 1,400, just about the same number as the credit spread. No anxiety whatsoever. And the straight stock was not as good. Once again, advantage credit spread. Eli Lilly. This one, the regression line was kind of going sideways a little bit. I decided, let's go ahead and do a bear call. So I set up a bear call here, and that was the 14 April, selling the 310 and buying the 320 further out of the money. $1.75, $1.57 credit. A lot more expensive buying the put, and I sold the stock short so that we are all together here. And you notice I'm investing about the same amount. Okay, so after the first month, it goes against us. I mean, it goes with us. It goes with us. So we're up $660 here. We're up 4,000 on the straight put, and we're up about 480 on the stock. Then it goes sideways. Well, that's our advantage with credit spreads. We're going up to $912. We're back down to 1908 on the straight put, and we're about the same on the stock. Then it goes against us. It actually goes up in that third month, which is fine. We gave a little of that back, but we're still positive as far as the credit spread's concerned. We've lost a bunch as far as having a straight put, and we've also lost on the stock. Once again, advantage credit spread. This is the easiest, best way, most consistent to make monthly profits, month after month after month, year after year after year. You don't want to get greedy. You don't want to worry about, fear. I teach you all the entry and exit rules to keep these all under control. A lot of people say, well, yeah, credit spreads, I can lose a lot more than when I gain, but I've got rules to make sure that when I lose a certain amount, I get out. I never take it all the way till expiration. I don't let the market trade me. I trade the market. Okay, so now let's take a look at some actual trades. This is a trade we made on Goldman Sachs from 2/7 to 2/22 of this year. And back here, I went in, I just had a measured move, so I got a bull put. I sold the 325 and bought the 315, again for about $1.77 credit. I went in with a call, straight call, $23, pretty expensive. 6 contracts of the credit spread, 3 contracts of the straight call. And then the stock was sitting at 368. And this was a relatively short-term trade. It went in our direction to begin with, but then it dropped back down. It made a major move against us. And this was a Fibonacci, and I decided to get out right around in here. Okay. We took a loss. We took a loss on this one, but we only lost $618. Okay. And that was for the 6 contracts. Versus the call would have lost close to 4,000. The stock only lost about 400, and I'm saying up here, well, that's a slight advantage, but you know, once again, with the credit spread, I don't have that anxiety that I have with the calls and straight stock. So I would say this is a very slight advantage. If anything, I'm gonna give it to the stock, but you know where my heart lies. This was a trade on Medtronics. A lot of these were very short-term trades, and we ended up losing a little bit on the bull puts, which is fine. Losing is part of trading, as long as you've got rules set up to get you out at a certain, minimize your losses. You're going to be just fine. We had a measured move here. We got in, and it went against us. Okay, so we got out on a measured move against us right here. Lost $540 compared to the call, down 3,000 compared to the stock, down 315. Well, okay, that's a slight advantage, but you know, I'm saying they're about equal, but I'll give it to the stock. I'll give it to the stock. And then we had a trade on Caterpillar, a very short trade. You can see we had a measured move on that, and we got in right here on March 2nd of this year. Got a bull put, 165, 155, quite a ways out of the money. The call I got was the 190 call, and the stock was sitting at 192. This was 1, 2, 3, 4, 5 days of trading. We were in there. We made $468 in 5 days on the bull put. Well, you could have made a lot more on the call, because this is the kind of trade that's good for the straight call and the straight put. About the same for the stock. Okay, so I'm going to give the straight call the advantage in this one, and that's the way straight calls and straight calls puts work. You can see in all these cases, the stock, we're outperforming, credit spreads are outperforming a portfolio of stock. Now, credit spreads are outperformed by straight calls and puts if the price moves in the right direction quickly. They're the most, but credit spreads are the most profitable and conservative trade in the long run. They yield consistent profits, and they're not susceptible to big drawdowns. Yeah, we're going to have some drawdowns. We're going to have some losers, but we're going to watch the risk profile. We're going to watch our charts. We've got rules on when to get out, and we manage that to make sure we can minimize the losses. Now, I show this chart a lot. These are why I believe credit spreads are the best. You get great returns. You get great returns. It yields monthly income on a consistent basis. You might have an occasional month where you lose, but losing is part of this game. As long as you execute and you know when to get out, you're going to make money in the long run with a proven strategy like the one that I have developed over many years of trading. You have a high probability of success. You'll notice that most of the credit spreads that I put on were way out of the money, way out of the money. Here we're selling premium because time is in our advantage. You don't have to constantly chart hawk, and it's low anxiety. That's why I love it. You have a better chance of winning when you're trading with low anxiety versus fear. And then you have a protection against loss because we're buying one further out of the money. This chart just shows my return on margin for the last 2 years and a quarter. I've got about the same equity curve for the 11 years that we've been doing this. So I just wanted to show you one that's relatively near term. This is the kind of equity curve all traders should have. Just a constant rise. Yeah, you have some drawdowns, you have some losing trades, but the drawdowns, you stay with it and you just continue on. Once again, I gotta say, past performance is no guarantee of future results, but I have been doing this for 11 years. Now, I would like to teach everybody how to do this strategy. I'm getting towards the end of my career. I've done this for a long time. I want to show people how you can be a consistent winner in the stock market. It's a difficult arena to win in. I know how to do it. My strategy is relatively simple, but it takes a little bit of time to master that. So right now I have a special on that if members come in and join with me, and they're here for 3 months, I give them the 4th month for free. So what I'd like to do is invite you all to go to www.optionsinfinity and join my community. And I hope you found this video valuable, and I'll talk to you later. Bye-bye now.